Mr. Ninan, welcome to this special show on Business Standard website. We just heard the Finance Minister Nirmala Sitharaman presenting her first budget. What are your first thoughts? It looks to all of us that if numbers are to be believed, it's a fiscally correct budget.
Well, there are two or three things. One, she actually put on a pretty impressive performance in Parliament and so far in the press conference where she's been quite aggressive in the responses to questions. So she's shown a certain amount of presence and confidence on a big day, which for a new minister in the ministry is a good thing. They've also highlighted changes outside of the budget framework on a variety of policies for the capital market, for specific industries like electric vehicles, housing, all of which would help. There are changes on the margin, but to the extent that you can do something, they've done it. Within the budget itself, whether it is a disciplined budget depends on how real the numbers are.
Okay.
We know that for the last financial year, even the numbers presented in February in the interim budget have turned out to be huge overestimates. I don't think there's been a previous time when the revised estimates varied so much from what are now called the provisional actuals, which the Controller General of Accounts has released, and which don't figure in today's budget.
Yeah, which is very little surprising.
It's very odd that the numbers are out in the market, the economic survey takes note of it, but the budget pretends that it doesn't exist. So it's still showing the revised budget figures of February.
That's right.
But if you take a comparison with the actual position on the ground in terms of the provisional actuals, then the revenue numbers are optimistic. And the shortfall that is there on tax revenue, they've tried to make up through extra disinvestment, which remains to be seen, and through money that they hope to take from the Reserve Bank.
That's right.
They've also given less money to the states, and most of the new tax impositions, the revenue is not going to go to the states, so the centre keeps the money. And on the expenditure side, there are very little changes, very few changes.
That's right.
The budget as a budget doesn't have very much. Most of what is going on is outside the budget in terms of policy changes.
Yeah, but there's one thing that comes through quite clearly is that, which is slightly disturbing, which is the protectionist tendencies of the budget, in a sense that as many as 36 goods have been identified and on whom import duties have been raised quite, arbitrarily picking and choosing them. So, I mean, is that...
Yeah, there's never much logic to these changes, but I think the Revenue Secretary has explained that they have reduced the import duties on capital goods and on raw materials.
To address the inverted duty structure.
That's right, and raised it on intermediates and final goods. So, to the extent that the duty structures needed to be correctly done instead of being inverted, they've done that. But this government has generally been mildly protectionist, and that stance continues.
Yeah. And which takes us to the question of, is there anything in this budget that you saw on exports? Because why I'm raising exports, because custom duty increase also indirectly hurts exports, because
in the budget, as a budget, there is very little going on. The expenditure numbers with minor variations are basically what were presented in February. So if the suggestion is that this reflects a new mandate and the new government's vision for the future, that does not show very much in the expenditure numbers, where they're going to spend the money. And on the revenue side, the effort primarily is to make up for the tax shortfall, which was not recognized was not there in February. And they're trying to sort of make up and cope with that. So the budget is a minimalist exercise. Most of the action is outside it.
That's right. There are two new initiatives in this budget. One is that the government is proposing to have a new privatization policy of sorts, wherein government will try to bring down their stake in listed PSUs below 51%. How do you see this initiative?
Well, there are several headline changes of that sort. Clearly, if they do manage to bring about a change by bringing down government shareholding in public sector enterprises to below 51%, that would be a major change. Because so far, except for the strategic disinvestment cases, like Hindustan Zinc, for instance, so far it's been disinvestment, but government staying above 51%. Now, if you drop it below 51%, then the traditional complaints about public sector being limited by the 3 C's, the CBI, CVC and CAG,
correct,
those control elements go away, and then those companies have greater freedom. So that would be a big change. Okay. I think the efforts to improve the bond market and the market for government securities and bring more investors in, including retail investors.
In treasury bills and government securities.
And the effort to create a long-term debt market in different ways. Those are responding to the immediate needs of a situation where the NBFCs are in trouble and not lending. The banks are not lending as much as they might. So to meet corporate credit needs from outside the banking system through the bond market, which is very, very sensible. I also think that the focus on tightening regulation in the troubled financial sector by bringing the RBI in
housing finance
outsourcers as for housing finance and more directly into NBFCs in a way. Both those, so bringing the RBI into that more firmly is also a good thing.
There is one proposal in the budget which is not fully understood, where the government is indicating its desire to enter the external markets and tap the foreign borrowing to meet its needs. Could you shed some light on how it will play out?
I don't know how it will play out, but it's the obvious thing about it is that the government, by borrowing abroad, will take the exchange risk. That if, let's say, the dollar goes up against the rupee and you have to at some point repay the loan, then you have to pay that extra amount in rupees. But if you keep borrowing, you could argue that in a sense it's never repaid. You keep rolling it over. But the gain for the government would be that interest rates abroad in hard currencies are lower than they are over here. So they might get a lower interest burden by borrowing overseas, as against allowing foreigners to invest in government securities within India in rupees, where then they take the currency risk, but then they get a higher rupee return.
That's right.
So it's that play. At the moment, foreign debt, sovereign debt is very low, as the minister said in Parliament.
5%.
It's only 5%, it's tiny. So up to a certain amount, I don't think it matters very much.
Two tax proposals that I was talking about. One is the government had earlier promised about 4 or 5 years ago that they will bring down the corporation tax rate on all companies to 25%. So far, the government had done it only up to 250 crore of turnover companies. And now in this budget, they've raised it to 400 crore. Isn't that this incrementalism of this sort? I mean, how do you see this?
I really don't understand why this is such a cautious step-by-step approach, unless you're worried about possible revenue implications. But the whole logic of it was that you reduce the nominal tax rate, which is high by international comparison, and take away some of the exemptions and concessions given. Because the argument is that large companies, in any case, de facto are paying less than 25%.
That's right.
Only about 23-22% is the effective tax rate because of the exemptions and concessions they have. So you withdraw those and you make the nominal tax rate lower, and then optically, and for many companies that don't use those exemptions or who have access to them, it becomes a fairer tax system. So instead of addressing the exemptions issue, they're just doing this bit by bit. Incrementalism. And I don't see what the great constraint is.
And on the so-called cash transaction tax has come in a different way this time, wherein if an individual or a company withdraws more than 1 crore of money in cash from the bank accounts, that company or the individual will have to have a TDS of 2%. Is it only a signal or will it really work? I mean, how do you see that it will play out?
Well, for most companies, I don't think 1 crore is a fairly high limit.
Yeah.
Most companies will not have very large cash transactions, but there may be some companies that do have
services sector companies maybe
large cash payouts of various kinds. I don't know. I can't imagine which ones it would be, but there may be some. But I don't know how this will work. It's very easy to open 2 bank accounts, or 3 and 4, and go to different banks
and beat the system.
And you beat the system. So I'm not quite sure how this is going to work.
That's right. Finally, we cannot complete the discussion without a reference to the defense budget. The defense budget has not seen much of an increase once again. If my memory serves me right, it is just 6% or so. It seems to be a perennial problem with the government not providing enough for defense.
This, our defense services desperately need equipment. There's no budget for them. We seem to assume that there will be no war. But the way to make sure there is no war is to be fully prepared. If you're not prepared, then the other guy is encouraged. Whereas if you're fully prepared, then that's a deterrent. That's how you prevent war. So I don't understand this position that whatever money you give, you're giving more in pay and pensions and benefits to the defense forces, which is okay up to a point. But if at the same time you're starving them of the equipment with which they will fight, then you're in the classic language of defense, you're getting more tail and less teeth. What you need is more teeth and less tail.
That's right.
And simultaneously, the reform of the defense structure, reducing the armed forces size while becoming more effective in the way that China has been doing, is not being done. So this is an area of neglect, and it's surprising because she's been defense minister.
Absolutely. One final question. This budget, at least on the basis of the numbers that it has provided, will be seen as having reduced fiscal deficit from 3.4% of GDP last year to 3.3% of GDP. Are you happy that there's been no fiscal excess as such? But are you also a little uncomfortable because there is not much, as they say in this budget, about growth?
One, it's not 3.4%.
Some people say it's 4.1% actually.
It is well over 4%. Because you've diverted expenditure and postponed expenditure to bring it down to 3.4%, and you borrowed outside the budget in order to pay bills. That's like on the food distribution system. You borrowed 90,000 crores from the small savings fund. That 90,000 crores should actually be in the budget. That would take up your deficit by 0.5% to 0.5%.
Right. Yeah.
So 3.4 will straight away become 3.9. Then there are other capital account bills that have not been paid. So it's definitely more than 4. So this is, fiscal fiction. I think 3.3 for next year, for the current year, does not assume such fudging, but assumes buoyant revenue, assumes a very successful disinvestment program, and assumes that they will get a lot of money from the Reserve Bank's reserves.
Okay. Let's hope for the best, Mr. Ninan. Thank you for taking part in this discussion.
Thanks, Sachin.